Hi, this is Aaliyah Ott with Inspired Capital Partners, and today I'm going to be sharing with you information on how to invest in commercial real estate. Now, my partners and I, we have a management team of 6 individuals with over 140 years of combined experience. On the screen there, you can see my primary partner, Terry Garner, and myself, Aaliyah Ott. We have a pretty extensive background, everything from wholesaling to owning rental properties and rehabbing in and out of state. We've had experience both on the residential and commercial side. And we've done that both purchasing properties as well as private lending and buying notes on those properties. So we have a really extensive background when it comes to investing in real estate. Our favorite thing right now is what I'm going to share with you, which is lending and working on self-storage properties in particular. Okay, so why commercial lending? Well, there's a number of reasons why we like commercial lending, but in particular, assets often cash flow from day one. So rather than a fix and flip where you have a defined exit strategy of reselling the property, if this property is held feasibly, you can cash flow it, especially as a lender, if you had to take it back. Granted, you're usually in the position only wanting to be the bank, but you acquire an asset that feasibly could cash flow. Individuals and hedge funds, Wall Street, all are now looking towards commercial real estate sector and away from residential in the coming years. The residential market has flattened out and the commercial sector is heating back up again. So this is where we're putting our focus, time, and attention. There's definitely, if you're the owner of the asset, there's appreciation potential. And one of the things that we do is sometimes we'll do equity participation, which basically is a fancy way of saying that we get to share part of the profit with the person that we're lending the money to. So in our fund, many of the assets that we have this sort of structure where we put a loan on the property and then we do some sort of back-end participation in that. We lend to businesses. So if you think about commercial properties, those are all businesses. We're lending to businesses with a solid plan and a track record. We're looking for operators that have a history of taking a property whatever condition it's in and executing on a specific plan to add value to the overall property itself. And then we also look at protective equity based on the ARV or pro forma of the property. So the pro forma or the ARV, what those stand for, ARV is more for residential terms. That stands for after repair value. Essentially, we're looking at a property, maybe it's worth $1 million today and it's a luxury home and it gets flipped in 6 to 12 months at a price point of 1.5 based on forced appreciation, which is, getting your hammer and nails and cosmetic repairs into that property, making it look better, and then increasing the value. Pro forma is based on more commercial property, which means you're increasing the value by increasing the revenue. And so when you're looking at purchasing a commercial property or evaluating a commercial property as a lender, you look at where it's at today, you look at the business plan and track record, of course, to make sure that someone can execute on that plan. And the pro forma tells you what its income could be once that plan has been fulfilled. So that's what we take a look at. And as I mentioned, there's shared profit in most of the properties that we lend on. Now, forced appreciation, what this is a term that is used both in residential and commercial real estate, and there's essentially 2 types of appreciation. There's market appreciation, which means the general market is going up and comparable properties are being valued more and more, or there is appreciation that's created by the owner, and the owner is adding value to the property, and that is what's increasing its resale value. So again, using the example of fix and flips, with residential, you're remodeling a property, you're doing lot splits, you might be adding on to the property to give it value that way. With commercial lending, it's based on cap rates and income to that property. So ways that you can add value is raising rents, increasing occupancy, adding profit centers, and lowering the overall costs to operate that property. Now, another term that is really important is knowing what the local cap rates are. A cap rate is the capitalization rate, and essentially what that is the net operating income. That's what the NOI stands for. So you've got net operating income divided by the sales price. And essentially the NOI is your income minus expenses, and that's your cash flow that comes in each month prior to calculating in your finance payments and any sort of income tax deductions there. And so the cap rate allows you to compare properties in any given market, and you'll typically find that within a certain radius your cap rates are going to be roughly the same for a similar asset class. So you might find a 1 to 2% variation, but typically you'll find a general cap rate for a specific metro market. So property one, how you get the cap rate is, again, you find your net operating income and you divide that by the sales price, and that's 10% in this particular case of property one. Property two has a lower sales price of only $800,000, and when you do that division, the cap rate comes out to 11.25. And then finally, property three has a much higher sales price. So you've got $90,000 of the NOI divided by a sales price of $1.2 million, and the cap rate on that is 7.5. And I would say that, cap rates typically right now are in the 10% and lower range. You might be in a nicer part of the country, let's say it's Southern California on the coast, you might see cap rates as low as 4%, which basically means that in order to achieve the same amount of cash flow, you're having to pay a much higher premium for that property. Well, I personally like to go where cap rates are a little bit higher, where I'm getting more bang for my dollar if I'm going to own that property. So just something to kind of keep in mind. Using the cap rate to determine value, here's another example where we have, let's say this is a self-storage property that you're purchasing for $900,000 based on the market value, and we calculated out the gross annual income was $168,000, and you'll see the calculation there, $100 a month in rent per unit times 200 units, which is 70% occupied for 12 months. So that gives you the gross annual income. And then you start subtracting out your expenses like insurance premium, property taxes, annual expenses, and management fees. And that's where we derived at the $90,000 there. So just using the example of how you can increase a property's value, you can make repairs, you can raise the rents, you can add value by vehicle parking, U-Haul rental, cell phone towers, and other miscellaneous sales in the office. That's something standard that we often do when Terry and I are purchasing our self-storage properties. You can improve management and improve, in the process of improving management, get your sales up and your customer retention improved. You can reduce your vacancy rates, and in this particular case we're reducing it down to 10%, which means now the property went from 70% to 90% occupied. And just that little tweak alone, along with raising the rents 10%, increased our gross annual income from $168,000 to over $237,000. And then we added our new profit centers, including U-Haul parking and cell phone tower rental, to gather another $40,000 in income for the year. And then we have, again, our expenses, insurance, taxes, and our management fees. Now, that went up a little bit is because we added weekend work hours for our employees, but hopefully by doing that, it gives a competitive advantage over the marketplace if we're open Saturdays and Sundays. So you'll see the bottom line there, the net operating income doubled. So I'm just going to quickly go back, show you the last slide. The bottom line there was $90,000. We now have that $180,000 net operating income. If you keep the same cap rate, 10%, the new market value of that property is $1.8 million. So this is how you could feasibly add a ton of value with really not a whole lot of work. I mean, if you're doing this right, it doesn't take that much to tweak the rents. It doesn't take that much to increase the occupancy ratio on a self-storage property in particular. You just have to buy in the right areas where the market supports that. Okay, so we've probably alluded to a couple things here as to why we like self-storage properties in particular, but the self-storage industry has been one of the fastest growing segments of the commercial real estate industry in the last 40 years. Now, self-storage is considered by Wall Street to be what we call recession resistant, based on its performance through recessions and good times and bad times, which that's just basically saying when the market went down in 2007, 2008 and onward, people were getting foreclosed on and they were losing their homes. And sometimes when you lose your homes and you lose your job, you've got nowhere to go but into a smaller home. You might have to rent an apartment for a couple of years. And so feasibly you could go from a 4-bedroom house to a 2-bedroom apartment. Well, all that stuff has to go somewhere. So this is what's awesome in terms of being recession resistant. When that sort of consolidation happens in the marketplace and people are getting shifted around quite a bit, they still want to keep their nice furniture. They still want to keep their prized possessions. And if their new home can't facilitate, being able to store all that stuff, then it has to go into a self-storage facility. So this is why self-storage and affordable housing locations typically don't get the big hit during recessionary times. Okay, so moving on from that, another reason why we like self-storage is there really is minimal tenant drama. Unlike apartment complexes, single-family homes, places where people dwell, we don't get the crazy calls in the middle of the night saying my toilet's broken. Actually, we did. Well, that's just a separate story. We had a dance studio that came with one of our storage properties, and they just had a small leak. So it really wasn't a big deal. But overall, I'm just saying, I'm making a point that there's minimal tenant drama. When you have homes where people live, there's laws that protect them. And in the self-storage arena, those laws don't apply because you're just dealing with people's stuff. You're not dealing where people sleep. So if your tenants stop paying, you can actually lock them out within days of defaulting on their payment. And if they stay locked out for long enough, they actually might have their items go to auctions. You might have heard of the movie, or the TV show rather, Storage Wars. I'll get into that later. But that allows us to maintain occupancy and paying tenants and encourage people to pay on time. It is very easy to remotely manage self-storage properties in comparison to other types of commercial properties. And we use an online management system that allows the on-site property manager to put in rental information. It allows us as owners to go online and see, exactly where we're at in the occupancy range. Do we have empty units? Do we have units that need to be swept out or repaired? How many units are occupied versus vacant? So we can see that visually in our eMove software system. And then lastly, if we're looking through the lens of an owner or a lender, what's really nice about self-storage is because it's such a strong asset class that continuously performs, it has one of the lowest default rates in the industry, and it is fairly easy to get loans. So what's ironic about all of this is in the fix and flip market, it's difficult to get a loan on an ugly, distressed house. But for commercial, distress usually means it's got lower occupancy. As long as you purchase it at the right price and it's performing well enough, you can still get lenders out there who will lend on something that's 50 to 70% full. So it's a lot easier for us to get loans on these types of properties. Oh, and let me just go back. It has amazing cash flow and appreciation potential. And you'll see that here in just a moment when we walk through our example of one of the self-storage properties that Terry and I own. So this is in Owasso, Michigan. Owasso isn't some big, burgeoning metropolis out there. It's actually near Flint, which is one of the areas that was hardest hit in the downturn. However, it supports itself, and when I show you the numbers, it gets very exciting when you boil it down. There's opportunity across the United States, folks, and you don't have to be in Southern California to purchase properties. You're going to get much better deals if you're willing to travel a little bit just to go purchase the property and set up your systems. So going back to the numbers here, we have 273 units of storage units. We have 21 parking spaces, 3 apartments. So that top picture there, that's actually the dance studio. It's our retail space. And the apartments are on the top and to the right of that picture. Behind it in the back is the storage property itself. You'll see another picture there on the bottom. So we bought this property 67% full. The purchase price was $635,000, and we had financing. It was a combination of our company Investors in Action and a commercial lender. So, I realize that we're sharing this from Inspired Capital Partners. Similar to how Investors in Action did this deal, Inspired Capital Partners would also do this deal in a similar manner. So, as an equity company, we could go into the second position lending note and take a ownership interest or a profit share on this particular property, or on this type of property rather. Flint has a population of roughly 100,000, and so this is again outside of that metro market. Average income is pretty low. It's a household income of $31,000, and the type of tenant that we're working with here is working class tenants. Owasso itself has really good schools, and so this is an attractive community for people who live in Flint and don't mind commuting a little bit. People are moving into Owasso where they're moving out of the Flint proper area. Now, what we did with this property really had some minor repairs. We had to fix the apartment roof. That was a few $1,000s. We had to fix the gate. I believe the outgoing property manager wasn't too happy about getting let go. He was not performing well, and that meant we had to hire some new folks. And the day after he was let go, we found the gate rammed. So that was an easy fix, just a chain link fence. No problem. We had to clean up the yard and the weeds, and it's so interesting to me how people just let their properties go. Simple things that cost a couple $100 a month to maintain, and they just let it go to shambles. It's a shame, but then it creates opportunity for investors like us that can see literally through the weeds and see what can be a potentially great property. So we also improved the signage. When we got to the property, I actually drove past it because I didn't even see that there was self-storage right away. So that was a clear sign that it needed signage. Needed the name and the phone number visible, and we also have U-Haul signs out front because that was another value add. We added U-Haul trucks, and we opened up the property on Sundays. So we extended the hours to include weekends, which before it was just open 9 to 5, Monday through Friday. Or I think it was 9 to 7, 9 to 6, 9 to 7. So we extended the hours. We hired another part-time manager, and we just made the advertising a lot more clear. We also advertised RV and boat parking. We offer boxes, packing supplies, locks that people can purchase. And that's not a big money maker for us, but it's a convenience, and it makes them happy. And we make a couple extra bucks off of it a month. But the biggest thing that we did to add value to this property is simply advertise that it existed. There was no online presence. When you drove by it, you could hardly see it. So just being visible to your target audience made a world of difference for our property. And you'll see that here in the numbers. So if you look across from the occupancy ratio, on the left-hand side, we started at 67%, and the NOI based on I think our second month of income, if we average that out for 12 months, it came to $72,000 a year based on our initial purchase income. Now, after 5 months, only 5 months, we went from 67% to 85% occupancy. And that was fairly easy to do with, again, just letting people know that we were there, putting a sign out front, and putting our presence online. When people are searching on Google or searching through U-Haul, people now know we're there. Now, that simple change translated into a value increase of over $300,000. And this is staying at the 11 cap, which was our initial evaluation based on our NOI and purchase price. After 12 months, we anticipate that we should be at an occupancy rate of 95%, and the NOI will increase by up to $130,000 a year. And that's pretty exciting, right? So $130,000 a year is our profit. Can't complain about that too much. And then the value jumps up to $1.182 million. And that's again at the 11 cap. Now, if you look down below, the market cap rate for that area, we bought it at a much higher cap than what the market is currently bearing. And that's good. That's good for us, because the lower the cap rate, the more the property is worth. So if somebody was willing to pay 8.5 cap on our property, once we get it to 95% occupancy, should sell for about $1.5 million. So just going back, we bought it for $635,000. We cash flowed it all the way to 12 months, and now the property is worth 1.5. And that's a huge profit potential. Now, just to set proper expectations, if you're not familiar with buying and selling commercial properties, you do typically have to season the books, meaning you have to let 12, 24 months go by at a consistent income to show to the next buyer. It's very difficult to sell it right out of the gate with that ramped up increase. You kind of need to show at least 1 year, if not 2 years, of solid tax returns producing the type of income that would warrant a higher sales value. Now, just kind of looking at the cash flow and the NOI, I put this on a chart for visual people like me to see what does this really mean. Now, I was talking about an NOI of $130,000 a year once we get it to 95% occupancy ratio. Kind of flattens out on the right-hand side. The first month we had back rents collected, no debt payment, and so we actually had a very good month of over $11,000 collected. The second month, it went down to $7,000 because we had one-time expenses, repairing the roof, repairing the gate, and legal fees. And that's when the debt payment started with our lender. So nice first month, second month, not so much, but then jump back up. Now, you'll notice down on the red line there, trending, there's a pretty big gap between the red line and the orange line. That's because we're paying a significant amount in debt, both in interest rate and some debt payoff. So we had a small $5,000 loan that we're chunking down at about $1,000 a month for the first 5 months. And then it spikes up again in March, right about the time when people come out of hibernation and start to move their stuff in and out of storage units again. So typically during the holidays, and specifically when it snows out in Michigan, you don't have a lot of activity. But once you get past the holidays, it goes back up again. And then you see some steady increase from March till July, and then it spikes up again in August. Now, what we're doing here is we're taking it back to a bank, maybe not the same lender that we started with, but we're refinancing it to a lower interest rate. Because we're able to show, hey, we took it from 67% occupancy, now we're at 90, 95% occupancy. We have some solid return on investment, and we'd like to refinance. We're going to look a lot more attractive on paper after month 12 than we were in month 1. So that should refinance the higher interest loans out and allow us to then increase the value of our monthly cash flow. So now everyone's favorite question that they love to ask me about self-storage is, what about storage wars? How does that work? Well, I'll give you a little website here you can check out. It's called storagebattles.com, and it's basically Storage Battles online. It allows you to go in virtually, see what's in somebody's unit, and bid online just like you would on eBay for a auction unit. So this is helping out the owners of self-storage properties that are interested in, checking out what's in units and listing their information online. Now, just a couple more myths to bust. We can begin the auction process literally within days of tenant delinquency, and every state has slightly different regulations regarding auctions. You have to publicly put them in the newspaper, so you have to notify the public, you have to notify the owner who's got stuff in that particular unit. And typically auctions are held within 30 to 90 days after the first notification. Bidders are not allowed inside the unit for liability reasons typically. Most auctions are handled by third-party auctioneers. As owners, we do not want to get involved in this process. We want to keep an arm's length distance from this whole occurrence. If somebody has, some amazing find, that's great for them. But more often than not, there's just junk inside of these units. It's just stuff that you'd find typically at a garage sale. However, sometimes you can find a gem or two. And I say that, I mean literally. We had our partner who's been in the storage business for years and years. He did an auction, and there was, I think, $25,000 worth of jewelry inside one of these units. So you never know. Life is like a box of storage stuff. Like, you just never know what you're going to get inside these boxes, right? So it could be a nice little find there. That made someone very happy, I'm sure, that day. We do delay auctions a couple months, typically for a couple reasons. One, then the main reason is there's economies of scale. So when we have to hire an auctioneer, it makes sense to auction as many units as possible. You don't want to bring somebody out and just auction off 1 or 2 properties or 1 or 2 units. It's better if we have 5, 6, 7, 8, 9, 10 units that we can auction at a time. The other reason is we really want our tenants to get caught up. I mean, we make that money back with the auction process more often than not. But we'd rather have the tenant pay and stay current, or be able to leave with their stuff. We like people to not lose their items to an auction. And just kind of like going back to the business of storage wars, because of the TV show, the popularity has made bidding on storage units more competitive, and the margins, of course, have gotten skinnier. So most people that do pretty well with, buying storage property is folks who own pawn shops and secondhand stores that have a delivery mechanism to get their stuff in these units out to a public and make a buck back. Or they actively sell things at swap meets and on eBay. Okay, so going back to what we buy. So again, Terry and I own a couple self-storage properties. Our company and companies like Inspired Capital Partners, we are positioning ourselves as a lender or an equity partner in these types of transactions. And in particular, what Terry and I like to buy is properties containing at least 150 units that are 40 to 70% occupied. We like markets that have at least a 50,000 person population within 5 miles of our potential unit. We'd like to find units that have site offices so that you can have on-site property management, extra parking or extra land that we can convert to parking, and at least 20,000 square feet of space. Otherwise, if we're getting it smaller than that, it's just difficult to make the numbers work as well. We do seek opportunities to add additional profit centers wherever appropriate. So sometimes that might mean a cell phone tower, sometimes it might mean parking. It might also mean if there's extra office space, we can convert that into people who actively are eBay businesses, or maybe we turn the office into some sort of shipping center. So there's lots of creative extra ways of making money. You kind of have to look at your local market, see who your clientele is, and then what needs they have and serve them well. We do target purchasing at cap rates that are 2 to 3 points higher than the market average. And again, the higher your cap rate is on purchase, probably the better deal you're going to get for the cash flow coming in. And we're always, of course, looking for assets where we can add value to it. We're not looking for assets that are already full and don't have any way to go up in value. And then preferably we like to find properties that have seller financing. We've gone the bank lender route and we've gone the seller financing route, and seller financing is by far the easiest way to go. So in summary, we like storage properties because they're increasingly popular with both potential owners and buyers as well as tenants alike. Storage is an asset with minimal liability and maintenance. I didn't mention this before, but the storage, the person who's renting the storage unit actually can pay their own insurance on the stuff inside, so you don't have to be liable as an owner. It's reasonably easy to obtain financing for the first position note due to low default rates, and it's a fairly simple process for managing tenants that don't pay or fall delinquent. You just put an extra management lock on there, lock them out, and then start the auction process. You can streamline your remote management through online systems and security monitoring. And again, we love self-storage because of the cash flow and appreciation potential. So to get started today, you can contact me, Aaliyah Ott, and that is Aaliyah@inspiredcapitalpartners.com, or you can shoot me a text. Text is way easier than just picking up the phone calling me sometimes if I don't recognize the number, at 858-774-2542. If you're interested in being a lender, definitely give me a call and we can chat about that as well. Thanks so much and have a terrific day.